Hey everyone, welcome to another edition of the Smart Investing Weekly Stock Analysis. As always, if you find the content in the video helpful, be sure to hit that subscribe button below so you can get access and find out about our upcoming Smart Investing Weekly Stock Analysis videos. Now today, before we actually pick a stock and break that down, I want to talk a little bit more about, Jerome Powell, interest rates, the central bank policy at this time. Of course, I'm kind of making some headways this past week after the Fed meeting. We have seen interest rates surprisingly, I'm going to say, tumble a little bit on that. That 10-year note is now trading around 1.4%. And after the Fed meeting, I was quite surprised because you've seen, Jerome Powell and the Fed, they've now announced they're going to reduce their bond purchases to about $60 billion a month starting in January. That's down from $120 billion in the month of November. So you're seeing that huge decline there. Also, too, it seems like that bond purchase program will cease to exist come March of next year as well. And generally what happens is when the Fed's not in there buying bonds, what happens is now there's less demand for those bonds. So the interest rate should, in theory, climb. Important to remember that interest rates and bond prices have a negative correlation. Very simply, if bond prices go down, well, that's because interest rates are going up. So that's why I was a little bit surprised. Also, not to mention that the Fed did announce it could have 3 rate hikes next year, and that's to kind of stave off inflation. But, the 10-year note didn't really move much on that news. And I think a lot of that is stemming from the concerns around Omicron, the coronavirus, COVID. Oh my gosh, we're having these lockdowns again. It's going to be terrible. And, here in California, we have a mask mandate where it feel like we're going backwards rather than going forward. I'll tell you my personal belief here is I think there's going to be just a flash in the pan. And what concerns me is now I think interest rates, especially on the 10-year note, could spike quite quickly next year and really hurt a lot of those bond investors. With that said, I think a good stock to kind of take a closer look at today is maybe one that can benefit from rising interest rates. Now, I'll tell you, a lot of the growth stocks, they don't do as well during rising interest rate environments. Reason for that is you have to discount those future cash flows using a higher rate. That makes those future cash flows less attractive. So I'm not looking at growth stocks to do very, very well over the next few years, as I think we will be in a rising interest rate environment. I'm instead, again, looking at what we do, which is the value investing side. And I think financial companies could be a big, big benefactor of that. One company that I thought we'd take a closer look at today is Citigroup. Citigroup, they have a lot of well-known credit cards. In fact, they do have 2 of my favorite credit cards at this time. They have that great relationship with Costco, which is one of my favorite credit cards, of course. And also, too, they have the Citi Double Cash card. I use those probably the 2 most out of any credit cards in my wallet. So we should all be familiar with Citigroup. They, I think, again, could be a benefactor from rising interest rates as they can now lend out money at higher rates, hopefully at a better spread to generate a higher net interest margin. So with that, let's take a closer look here at that company, Citigroup. We know it's a bank, a diversified bank here. You can see short percentage of float, not very high at 1.9%. Institutional ownership, pretty high at 77.6%. I mean, looking at the valuations on this company, it just really blows me away. Look at the price to earnings multiple at 5.6, below the industry average of 7.5. Price to sales at 1.7, also below the industry average at 2.3. And this is just, it's amazing. And the price to tangible book value at 0.8, well below the industry average of 3.7. If you look at price to cash flow at 2, that's also more inexpensive than the industry at 2.6. And the PEG for the forward earnings is 0.3. I mean, that is a tremendous PEG ratio, also better than the industry at 1.6. Let's look at the growth rates here. You see over the last 1 year, earnings have climbed 106.3%, better than the industry average of 92.9. The 5-year average, well, that matches the industry at 17.9%. Unfortunately, sales have declined 6.3%, while the industry was down 2%. Over the last 5 years, sales growth has been flat. Going forward, though, the 5-year estimated earnings per share growth, 19%, a very, very strong rate here. And one thing that I'll bring up that I'm kind of surprised by this on is the last couple of years, we've seen great earnings from the big banks. Reason for that is they had to take a lot of loan loss reserves. And when things were very difficult with COVID, it really damaged their earnings. They had to kind of stash money away, which depressed those earnings. Well, as things have improved in the economy, they have got to remove those loan loss reserves, which has been a great tailwind or a great benefit for earnings to the big banks. Now, I don't think we're going to have the same loan loss reserves benefit that we've seen over the last couple of years here. I think it instead is going to be about flat, as a lot of the loan loss reserve has already been realized. And I say last couple of years, but I mean is actually the last year. It seems like COVID has been so long, but it really has been a last year benefit for the big banks. So 19% growth over the last 5 years. I'm not sure if the analysts are looking at just in terms of interest rates rising. That's what's going to be a big benefit. Perhaps stock buybacks too. A lot of the big banks do buy back stock. So we want to understand, where is that potential growth going to come from for Citibank. Looking at the dividend, you get a nice $2.04 dividend from Citibank. See, dividend yield 3.4%. I always say that's better than you're getting in the bank account. That's for sure. Pretty nice dividend, I'd say, but they only use 19.2% of their earnings to pay that out, which gives me great confidence in that dividend. You can see here, as I kind of talked about with buybacks, you see the buyback yield 6.3%. That's pretty strong. They buy back a good amount of stock here. I wouldn't be surprised to continue to see this bank buyback stock as they pass the Fed stress test on an annual basis and submit those plans. Now, looking at the balance sheet, turn to that, a little bit different with banks. So you see the debt to equity is 140%, better than the industry average, 150%. No current ratio, no quick ratio. Reason I say it's a little bit different is bank accounting was different than, let's say, accounting for a retail company. Banks, loans are actually assets. So it's different metrics that you look at. Long story short here, I'm not worried about the balance sheet for Citigroup. I want to take a closer look, but on the surface here, it looks fine. Looking at the net margin for the company, 31.9%, does beat the industry at 31.7%. Return on equity at 10.9%. I like to see that a little bit higher. You see the industry average at 11.7%, and same for return on invested capital at 6.2%, below the industry average of 8.9%. Now here you can see the current price for Citigroup, $59.54. The 52-week high, wow, $80.29, and the low, $57.40. You can see year to date, this company is down 0.5%, and that's quite the surprise, because if you look at companies like JP Morgan, Bank of America, Wells Fargo, they've done quite well this year. So I'm curious what the dichotomy is here between Citigroup and the other large financials. Looking at this company in the past, I knew that they had a little bit more of, I'll call it an international business. I'm not sure if that's weighing on the company, but would definitely want to look into it, as the underperformance, in my opinion, could create a potential buying opportunity for this large financial business. Now, as we always like to do, we like to go forward and see what we're paying for those future earnings. You see here, we'll go to December 2022. You see estimated earnings per share of $8. Well, that would give us a target sell price of $132.80, well above, again, the current price of $59.54. I mean, this company's going to be trading here on a fire sale. I mean, it is a great valuation. Again, you get a great dividend. One thing I did point out too is you can see the earnings per share year over year from 2021 this year to next year, 2022, they do decline quite substantially. I do believe a lot of that is because of the loan loss reserve benefit that they saw this year that will no longer be occurring in future years. But again, at $8 a share, that is a very reasonably priced company, or what you're paying for the earnings at $8 per share, I should say. So with that, I think Citigroup, a very interesting company here. I would rate this company a buy. With that said, I would do further research. Just because the numbers look good, you do have to dig down a little bit deeper and make sure everything still looks good under the surface, as there could be some reasons for this company trading so low. But again, on the surface, I think there could be some great opportunities in Citigroup over the next few years with the strong valuations. With that said, thank you so much for watching today's Smart Investing Weekly Stock Analysis. Again, this video is for informational purposes only and should not be used as investment advice. But if you did find this video helpful, informational, be sure to check out our Smart Investing with Brent and Chase Wilsey page. Be sure to hit that subscribe button below to be informed about future videos. Thanks for the time.